A symmetrical triangle pattern is a chart pattern formed by the convergence of two trend lines, where the upper trend line slopes downward and the lower trend line slopes upward. This pattern is called symmetrical because both trend lines meet at a common point, forming a triangle shape. Symmetrical triangles indicate a period of consolidation or indecision in the market, as the price range narrows over time. It represents a balance between bullish and bearish forces, with neither side dominating. As the price approaches the apex of the triangle, the range between the two trend lines becomes narrower, signaling a potential breakout in the near future. Traders often watch symmetrical triangles for potential trading opportunities. They typically look for a breakout above the upper trend line, indicating a bullish move, or a breakdown below the lower trend line, indicating a bearish move. The breakout is usually accompanied by an increase in trading volume, confirming the validity of the breakout. It's important to note that not all symmetrical triangles result in a significant breakout. Sometimes the price may break out of the pattern only to reverse back into the triangle or move in a sideways direction. Therefore, it's crucial to consider other technical indicators, market conditions, and fundamental factors when making trading decisions. Symmetrical triangles can be found on various timeframes, from short-term charts like intraday charts to longer-term charts like daily or weekly charts. Traders often use them in conjunction with other analysis techniques to increase the probability of successful trades. When trading a symmetrical triangle pattern, there are a few key steps you can follow. Identify the pattern. Look for converging trend lines, with one sloping downward and the other sloping upward, forming a symmetrical triangle pattern. Make sure the pattern is well defined and has at least two touch points on each trend line. Determine the direction. While the symmetrical triangle pattern itself doesn't indicate the direction of the breakout, you can analyze the preceding trend for potential clues. If the trend leading to the pattern is bullish, there may be a higher probability of an upside breakout. Conversely, if the trend is bearish, a downside breakout might be more likely. Set entry and exit points. Decide on the entry point for your trade. Some traders prefer to wait for a breakout above the upper trend line, bullish breakout, or below the lower trend line, bearish breakout, to confirm the direction. Others may opt for a more aggressive approach and enter the trade near the apex of the triangle to catch the early stages of the breakout. Consider volume. Volume plays a significant role in confirming the validity of a breakout. Look for an increase in trading volume when the price breaks out of the pattern. Higher volume can provide more conviction that the breakout is genuine and may lead to a stronger price move. Set stop loss and take profit levels. Determine your risk management strategy by placing a stop loss order to limit potential losses if the trade goes against you. This can be set just outside the triangle, allowing for some flexibility. Additionally, set a take profit level to secure profits, considering previous price levels or technical indicators that may act as resistance/support. Confirm with other indicators. While the symmetrical triangle pattern can be a useful tool on its own, it's beneficial to use it in conjunction with other technical indicators or chart patterns to strengthen your analysis. For example, you can combine it with momentum oscillators, moving averages, or support/resistance levels to increase the probability of a successful trade. Manage risk and monitor the trade. As with any trading strategy, it's important to manage your risk and closely monitor the trade. Adjust your stop loss and take profit levels as the price progresses, and consider trailing your stop loss to lock in profits as the trade moves in your favor. Remember, trading involves inherent risks, and no pattern or strategy guarantees success in the market. It's essential to practice proper risk management, use appropriate position sizing, and continually educate yourself to improve your trading skills.